Since 1972, the McIlvaney Financial Group has been a conservative, contrarian investment firm. With that mindset, they have created a multifaceted approach to portfolio management, offering a wide array of services including wealth management, a unique short fund, hedging through precious metals, and excellent educational resources. We have had David McIlvaney on our show multiple times because we respect his outlook, viewpoints, and recommendations. You really need to let them give you a much better understanding of what true portfolio diversification is. Just go to mcilvaney.com/Main Street, with Main Street all spelled out, to get introduced and to garner free information. Again, that's mcilvaney.com/Main Street to schedule your free 20-minute consulting session. Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I really respect his work. I've been following it for years. He has decades of experience in corporate America. He runs the market research site for global macro analysis and analytics for professionals and serious investors. His YouTube channel has over 5,000 subscribers and over 1 million views. And he also runs the Financial Repression Authority company with a business partner. Gordon T. Long, thank you for joining me again.
Thanks, Jason. Thanks for having me. I haven't talked to you in a while.
Yeah, it's been a while, but I'm really excited to talk to you. We were talking a lot before we started recording, so there's a lot to discuss. I know you cover the global macro picture very extensively. So before we talk about other countries, let's talk about the Federal Reserve, since the market seems to think there's going to be a June interest rate increase. What do you think the Fed will keep raising rates?
They're going to keep talking about raising it as long as they can. There's the chance that they might, in fact, get 2 rates through before they realize that they're wrong and have to reverse. The bond market's pretty darn clear, and I think they've been proven wrong. So there may be a June increase. It's really irrelevant, Jason. The whole issue is whether, in fact, they're going to be able, what they're going to do with their balance sheet. And that's what everybody's watching, because, if by reducing their balance sheet from $4.5 trillion down, which it's at right now, and by the way, that's the same size of balance sheet as Japan and the ECB have, coincidentally, and to start reducing it would be effectively quantitative tightening. And it goes back to the question on the rates. It's my opinion that we have a recession. We're on the verge of a potential recession in the U.S., late fall, early 2018. We have a global trade volume slowdown that is staggering. And we're starting to actually see the economic numbers in the United States showing it a little stronger. So the Fed will be forced to come off this current policy. But if in fact whether they're naive or whether there's something else that they're planning on doing.
Now, I know you've been talking about financial repression for years. I've been talking about it as well. But, the Federal Reserve, in face of the real economy, a lot of evidence, whether it's the auto loans that are getting bad, the student loan debt crisis, the pension funds getting worse. There's so many examples that the real economy is not doing well. The Federal Reserve, is claiming the economy is doing well and that they need to tighten and raise rates. So how do you think that fits in then with the financial repression scheme? Because I thought, in your work over the years, since the 2008 financial crisis, all these central banks have seemed committed to financial repression. So it seems, hypocritical for the Fed to want to tighten again. I don't think that they can really continue to sell off their balance sheet and also raise interest rates.
You're right, they can't. This is propaganda to manipulate and keep up asset prices as long as they can. And of course, they believe they can keep them up definitely. As long as I've been doing this, I've never seen the Federal Reserve or any central bank able to overcome the normal business cycle or the credit cycle. It is too massive. They can delay it a little bit with interest rate movement, but they can't. They've never been able to stop the business cycle. The credit cycle, Jason, has turned. And you mentioned just now auto loans and all of the loan structures. The commercial industrial lending is falling and falling dramatically. The tightening is already happening with tightening standards because the default rates are going up. The auto industry is in serious troubles right now, and the volumes themselves are already starting to show because the tightening that they're being forced to do with the auto loans, because they do so many leases. And so, 90 days ago, they were expecting something in the area of 17.5 million annualized auto loans. Today, they're looking at, or a rate of auto sales, now they're looking at probably 12.6. That's the latest numbers out, because we've had 5 months back, 5 months of down falling auto sales, and Ford are feeling it, General Motors, we have inventory stuffing. But the point I'm making, and the reason it's happening, is the loans themselves are tightening up. Because there's so many bad loans, there's subprime, deep subprimes that are starting to default. And so when the credit cycle turns like this, it means the business cycle is turning, and they turn in parallel. The Fed can't stop that, and you don't stop it by increasing rates or do quantitative tightening. So they're really, to give them a benefit, what they're trying to do is to increase their firepower. So as they have some reaction to say, we've been forced into this because of well, they'll have some excuse. My opinion is they'll blame it all on Donald Trump. No, I believe whether you support Trump or not, I believe there could be, not the Fed, but he's being set up to be the fault guy for some of for some of this. But the Fed will come off of it, will be forced to come off of it. And the bond market's already telling us that, Jason. The bond market's too smart. There's too much money in there. They know what's happening.
Well,
and I think Lacey Hunt, and we were talking before the show, in Austin, Texas, is probably one of the most brilliant guys in understanding the bond market. He still thinks we're nowhere near the lows on this particular cycle on the bond market, and that is a 10-year down below 1%. He won't say 1%, but the lows are not in, and the low we had, as you know, last summer thereabouts was 1.25. Well, that says it, and the yield curve saying that. So the slowing is happening. There's no question a cycle has turned, and the Fed can't follow through in this policy. We will know that in spades by August. But they're fair, and the reason also, Jason, they're terrified that if the equity market, as it should, starts to correct, if it corrects more than, my guess is 10 to 15%, the amount of leverage that we now have built into the system is the ability to stop that unwinding of that leverage would be almost insurmountable. We've always been blessed in the past in many ways because the Federal Reserve could step in with various facilities like we did in 2008 and stop it before it got out of control. This time the problem is global, and it's all the central banks, and it's all the countries, all the stock markets. If you were, it's all the pensions and the pension defaults that would start to spring up. It's all the insurance companies. There's not enough money to really stop this thing if it starts to get out of control. And especially, Jason, most of the money today moving into the markets coming in ETFs. And these, I love the product in some ways, but they're weapons of mass destruction. The reason you buy them is you want liquidity, a keystroke. And if you recall, in 2008, when we broke the buck at the Federal, the Reserve, the money market fund, was $5 trillion in one afternoon that started to move because it was a keystroke of Treasury officers and chief financial officers protecting their money, moving it out of asset-backed securities and moving it into treasuries. And so there was a panic as Paulson and Bernanke charged off to Congress to say that to closed-door meetings, we got to stop it. But they could. They were able with, 12 different facilities. This time they can't, and they know this. And if you look at Janet Yellen, she gets a lot of press. But really the guy running the Federal Reserve, in my opinion right now, is Stanley Fischer. And we did not bring Stanley Fischer in as the co-chair, and he has a low profile, and his job is making sure we have market stability. The reason we don't hear from him is he's busy trying to create market stability because of what I'm talking about. Am I making sense to you, Jason?
Yes. So basically then, to summarize this, is you described a bunch of different potential economic landmines, what I've been saying now for a while for my listeners. There's so many. There's commercial real estate. There's the student loan debt crisis. There's the auto loan bubble in the United States. There's the pension fund crisis. And the central bankers, they've created all this currency, but a lot of it hasn't necessarily gone into the real economy to, create hyperinflation, but it's gone into regular, normal asset markets instead. bad. So it's gone into bond markets, government bonds, corporate bonds, so large corporations can borrow even more cheaply. It's gone into real estate prices, and it's gone into different stock markets.
It's gone into finance. You're absolutely right, and your logic is going into financial assets. And the reason it's different this time, because it usually starts to show up in price inflation in terms of goods. That is, and labor costs. So your labor numbers go through the roof because everybody's wanting more salaries. Your food costs are going up, et cetera. That is not happening this time, because, well, to some degree in food, but on a global base, because we have global arbitrage of labor. So the fact that all the labor in the supply chains is really deflationary. We have the internet coming in many ways, putting tremendous downward pressures on labor rates. Yep. So we're not seeing it. It's there. Don't get me wrong. It's there, but it's not the pressure that it was back in the 70s during Jimmy Carter's problem, as we really had stagflation. But it is there, and it's in assets. Now they can keep printing, and as you print more, they put more money out. The assets keep coming up, but at some point, the liquidity no longer translates into credit. And credit only becomes available, and it can use it if you can post collateral. And collateral comes from creating real wealth. And so right now, Jason, the issue is we're not creating enough new wealth. In other words, as what you said, the money's not being invested into things that will create real wealth, that is productive assets. Let's call it business machinery, for example. It's being spent on consumption, and we're a 70% consumption economy. So to keep this thing going, but so the money, the investment is not being tied into creating real wealth. So we have, for example, to put it into perspective, the global economy, a debt right now, a global economy is about a $72 trillion economy globally. We have $220 trillion thereabouts, according to McKinsey, of debt. If you take that $220 trillion debt and you use about a 2%, you come out with about a $4 trillion a year debt burden. That's money that just sucked right out of the economy. That's fine if that's being invested properly and the GDP grows. But right now, our GDP growth, even if you used something in the area of 2.5% on that 71 trillion, is down around 1.8 trillion. So you have a gap of 2.4 trillion thereabouts. And by the way, 2.4 trillion divided by 12 is 200 billion, which is exactly the amount of money the central banks are pumping into the system. That is the Bank of Japan, ECB, Bank of England. I did not say the Federal Reserve. And by the way, I was mentioning earlier, I did the numbers of where I think they're at right now in terms of the global debt as it's being increased. What I've looked at, what's happening with the GDP, and my numbers say the gap is about 3.1 trillion, which is $260 billion a month. And I noticed that, I guess it was SocGen, Societe Generale, showed that the central banks have actually pumped out $1 trillion in the first quarter. So they're more money, even though they're talking about winding things down, they're actually increasing it. Not yet in the Federal Reserve, or at least knowingly. They may be doing it with swaps. They may be doing it ways that are not evident to us. They will at some point. And it's part of this Bernanke's Enrich Thy Neighbor, where they rotate around so that they currency debase without anybody really seeing it, because it's all part of what I refer to as the currency cartel. So the next wave will be the Federal Reserve having to take turns and increase its balance sheet. That is absolutely 180 degrees from what they're currently saying they're going to do.
That would really spook the markets at this point.
Oh, big time. That's why it's going to be handled gingerly.
Yeah, so I think, Gordon, to summarize this for our listeners, I think you've laid out the case for that all these the major global central banks, the 6 largest central banks, they're not going to be able to reduce their balance sheets meaningfully. Number one, I don't know who would buy a lot of the stuff.
Jason, they will never reduce their balance sheets. These balance sheets are permanent, and they will increase. And I have a very close friend of mine, Richard Duncan, in Thailand, and Richard was in the International Monetary Fund, the World Bank. He was in Thailand when it was the crisis, and he understands this in detail. And he argues emphatically that right now what it is they're just really removing the debt that is, the debt on the balance sheet of the Federal Reserve is a way of reducing the overall bonds that are out there and the debt. It'll never be brought back. And I'm not articulating that quite right. Let me explain it this way. The Fed may be sitting on $4.5 billion. They get interest on that money that's paid to them. All that money, they just turn around and hand the money back to the Treasury by law. So it costs the Treasury zero. It doesn't cost the Federal Reserve anything because they created the money in the first place. So they just sit there. So they will sit on these bonds until they expire. They will do nothing. And it's a way of removing the debt. He believes emphatically that's the strategy that they're under. So there's no incentive for them actually to get rid of the debt.
And the central banks don't have to declare bankruptcy. So even if they're technically insolvent, they can.
They are insolvent, but there's no such thing as insolvency when you can print the money.
Exactly. It's like Monopoly, where if you're the banker in Monopoly in that game, you can just take more money out. So you just start over. Yeah.
The way to look at it is, what is the balance sheet of the Federal Reserve as a percentage of the GDP? And the GDP and the rate of their balance sheets growing at the rate of the GDP says that doesn't compute. And that goes back to what Lacey Hunt's arguing is, quite emphatically, has been right, is the velocity of money has measured on the M2 has been continued to fall. It's been falling consistently, and it's not just the United States. If you were to look at China, the U.S. rate right now, about 1.42 is the leverage we have. EU's about 1. China and Japan's about 0.6. So the other countries are worse. They have bigger growth of their balance sheets as a percentage of their GDP because their debt is getting to be so large. So the velocity of money is falling. If you're not going to turn around things with velocity of money falling. It's just not going to happen. Well, it means because the money's not being used properly. It's just being consumed. And it goes back to my point I tried to make here about wealth creation.
Yeah, and it looks like the central banks, Gordon, are trying to coordinate a large global debt for equity swap, like Catherine Austin Fitts has been saying for years now, where they just create more currency, but then it ends up going into more assets instead of debt. But China actually...
I think that, Jason, you're right, and she's right. That's the only way this makes sense, is that what's going on is a global asset debt for asset swap. The only hesitation I have is I'm not so convinced the central banks are that smart. I'm not trying to disparage them. They're very bureaucratic. Let me put it that way. They're very dogmatic in their practices of what they've learned. They're all Keynesians. And so you get locked into groupthink. So it's hard for me to see that they're being that creative and that imaginative in orchestrating that. What I could be led to believe is that the powers behind the scenes, the real true international banking smart guys, know this, and therefore are really really controlling. And they do. Arbitrage. Legislative arbitrage is a game that they're all practicing right now, and that is using government policies to your advantage and using lobbyists to influence it. And there's no question we know that's happening. So I think the strategy is that. I'm not sure the central banks have woken up that that's how they're being played into this. And we saw a lot of this when we were doing the work at financial repression you mentioned earlier, because financial repression is alive and well, but it's shifting, it's changing. It's not just about the bond market anymore. It's about the equity markets. And more of the central banks in keeping assets up and rising up asset prices are in fact in moving these, protecting the equity prices and driving them up. Because what happens is the corporations, as their stocks go up, their stock price is their currency to take over and buy other companies and to buy other assets, whatever those assets might be, as long as they can hold those stock prices up. And that's why, for example, that's why buybacks have been through the roof. And the debt that they've piled on has been astronomical because it reduces the number of shares outstanding, even though their earnings are falling, and it's been able to protect their share prices. It shouldn't drive their share prices up, but it has been because the money that's been flowing in has been flowing into ETFs, and therefore these stocks get the push.
And also, Gordon, to add to your points there, with financial repression from all these global central bankers, people have been chasing stock prices higher for any type of dividend, because there is, if you're a retiree and you have a couple $1,000,000, in the past you could live off, government like U.S. Treasuries, the yield on that. But now you can't. You have to have $10 million to get like $30,000 or $40,000 in interest payments on Treasury yields. So
You're absolutely right.
That's what's forced money into the stock market now, and also forcing stock prices higher. Besides these share buybacks that you laid out with the artificially cheap debt and the financial engineering, is financial repression. Because if you're a retiree and you need income, your stockbroker is going to tell you to go buy these dividend stocks to go get the dividend yield. And you have people,
and they've been right. It's been the only way in the last few years, if you're a retiree, is you had to buy dividend yielding main blue chip kinds of stocks, because the stock price has continued to be forced up because of the buybacks. But additionally, and you correctly point out, they're also using the debt to fund the dividends. They do not have the EBITDAs, the earnings before taxes, depreciation, amortization, free discounted cash flow, has been falling at such a rate they no longer have the cash flow to even pay the dividends. They're, in fact, vast majority are borrowing the money through floating bonds to pay their dividends. That's a fact.
Yeah, it's crazy.
That's how terrible. But they need. But if you're a CEO and you've got no growth and you can't see the growth, this is the only way of sustaining it. But that's slowing, and that's a really important point right now, Jason, to our listeners. The buybacks are slowing dramatically because of this credit cycle's turned, and the credit agencies are saying your debt is too large against your cash flow. You got to do something, get your cash flow up, or get your debt down, or stop the growth of the debt. So the buybacks are starting to slow quite significantly. Now, they haven't taken down their credit ratings yet, but their threat, which is their warning, yeah. and that always happens in that way before they're ever taken down. So that's because, as we talked about a few minutes ago, the credit cycle has turned, and those are examples of it. That does not mean we're imminently going to see a stock market crash at all, Jason. What it means is we're going to see a shift in the central bank's strategy of where this cash is going to go, where it's going to be applied. And you're going to see more, and we could talk about helicopter money, et cetera, but you're going to see more and more of this money flowing into the stock market as buys. We were saying earlier, 12 of central banks are now officially buying the stock market. Bank of Japan, 60% of the ETFs are owned by Bank of Japan. That's a fact. We have the Central Bank of Switzerland buying $20 billion last quarter of the FANG stocks in our stock market. That's a fact. By the way, I happen to speculate. I think Stanley Fischer is behind that. That's why they're targeting it. But we have 12 central banks now. Why wouldn't the rest of the central banks start to do that if they want to protect their assets? And it's all because you just laid out quite well the amount of bubbles that we got going. Any one of those could be absolutely devastating. And they're going to do other things too, Jason. For example, you mentioned student loans. There's a bill being floated as we talk right now in Congress that what they want to do is they want to take away, in the student loans, they want to take away the non-recourse element of student loans. What that will allow, the government's still guaranteeing the student loan if it ever goes into default, but it means a student can take it into default or take it into bankruptcy court and have it discharged. Right now, they cannot discharge their loan. They can have it put into forbearance and delayed, but they can't get out from under it. They or their co-signers. So if it goes into forbearance, if they go into bankruptcy and can file bankruptcy, by the way, it'll be a whole new industry that'll explode, as every student, the first thing they'll do is make sure they declare personal bankruptcy to get rid of the loan before they have, start getting too far into their career and have it discharged. It's interesting that, of 1.4 trillion, numbers would speculate that probably, we already have 600 billion of that's in forbearance, which means they won't pay it. The chances are it'll be about $1.9 trillion that would be discharged through the next 24 months or 36 months in bankruptcies filings, and that equals about the 900 billion of money that's rolling over of U.S. Treasuries held by the Federal Reserve that would have to be offset in some fashion. So that would be offset by the United States government issuing new bonds to pay for the debt, because even though they've guaranteed it, they have never paid the money. The money still has been lent by the banks. Are you with the logic there, Jason?
Yes. Yes.
So I'm speculating there, but the numbers line up too closely, and the bills are coming through, if you watch what's happening, to suggest that's not the unfolding strategy in place. I'm not being a conspiratorial buff or anything else here. I'm just being a pure monetarist and looking at where the money's going.
Well, there's a lot of conspiracies all around us, Gordon, with politicians, with the Russians, and I don't want to get into that right now. But I want to ask you,
because
it's
just a distraction. It's distracting us from how bad the economy is. And Trump has done some really good things. The devil deserves some credit. He's been able to create the interest in more jobs. So the job numbers here this morning were a complete and unmitigated disaster. And you look at the amount of participation rate, you look at the type of jobs and what they can pay, et cetera. But he has been doing the right kinds of things. But you don't believe for 1 minute the tax bill is ever going to get through in a timely fashion, and whether in fact it'll be effective. So that we're being the propaganda is distracting us vis-a-vis Russian and all this crap that I can only use to describe the media right now. But it's also misleading us on how effective Trump will be or can be. And I would put the blame right at the foot of a Congress that's so polarized it can't pass any bill for any reason. So, but it's taking our eye off the fact that the economy is slowing in the U.S. at a phenomenal rate. And I go back to why I think there's a recession that's coming. And by the way, the recession cycle is usually 6-7 years maximum. We're going into our 8th year. And we've spent how many $1 trillion? We've increased by about $3.5 trillion just to get it to this level at a GDP growth of maybe 1.5%. And this is the end of the recovery? Hello.
That doesn't even count the at least $20 trillion in currency swaps that were done during the 2008 financial crisis. Starting in the 2008 financial crisis through now,
Precisely.
To put out fires, because Deutsche Bank, I'm sure we've talked about this in the past with the European banking crisis. I mean, a lot of those banks could have triggered huge derivatives problems for the banks, and yet basically nothing has happened so far. A few of these European banks have been nationalized by either Ukraine or Italy nationalized their largest bank. But yet, it hasn't caused a chain reaction like many thought. And my explanation for this is, I think, Gordon, you mentioned the central bank coordination. I think these central bankers are having conference calls, maybe not necessarily every day, but maybe at least once a week to say, oh, is this bank about to fail? Okay, we're gonna preemptively, create this extra liquidity program. We're not going to tell anyone about it, because they don't have to do any transparency with their balance sheets. There's no independent audits. So they could.
You're right on, Jason. I don't think many people grasp what you just said and grasp it. We have, for example, right, and you're right on with regards to the swaps. We both know that the swaps marketplace is probably $650 trillion. We're talking 10 times the size of the global economy, and that's all in interest and currency swaps. It's massive. It's over the counter. It's totally. There's no transparency. It's all controlled by the international banks, and very few people have true visibility to all the underlying moves and collateral that are guaranteeing it. And they certainly can't have any massive shifts in currency values or yield rates, or that 650 trillion would come down. So, but the point I'm getting to is right now we have a euro dollar problem around the world. The United States dollar is still the main funding vehicle around the world. And the dollars through the different paradox that we have as debt is what keeps the global economy going, because it goes onto their balance sheets and they can leverage it up. Well, right now that's not happening. There's a real dollar shortage out there. It's one of the reasons the dollar's been so strong, because they need it to do their lending. They need it to pay money, to pay their interest. They have $9 trillion that's funded in US dollars, and their economies are weakening, their currencies are weakening against the dollar. They need more dollars to pay it. So there's a real problem there with the dollar. But the point was wanting to lead us to is the way they're holding this up is they're doing currency swaps. The central banks between them are doing currency swaps. And the Federal Reserve, and I posted a number of charts at MATA SII on our site showing that every time we get into a problem, the United States comes to the rescue of the other central banks through U.S. dollar currency swaps. That's transparent to the world, not to the markets, not to the average investor. So the thing to watch, the message to your listeners, Jason, is watch the currency swap transactions out of the Federal Reserve. They don't make the headlines, but watch them. They have to post them and watch as they increase. And I think we're due for some because I think we have this credit cycle. It's one of the ways they're going to try and push it out a little further. So there's lots of things to watch for if I'm right here.
Gordon, I think if things get bad in China, and most people don't realize this, but the People's Bank of China has actually created more credit than anyone since 2008. So if you don't count the currency swaps, no one has expanded their balance sheet more since 2008 than the People's Bank of China. They've expanded their balance sheet massively. They've put in massive amounts of credit into their Chinese economy. I think there's over 28 trillion RMB in there. When you convert that to US dollars, it's a massive, massive number, larger than any credit injection that any other economy has done. So I think if things get bad enough in China, Gordon, I think you could surprisingly, and this would surprise a lot of people, would not surprise me. I don't think it would surprise you based on the discussions we've had, but I could see the U.S. and the Federal Reserve and the People's Bank of China doing a currency swap. So the Chinese then don't get a full control of the next global financial system. China has to play ball in this, yes, they can accumulate gold, but, then they can't have their own complete gold-backed currency or anything like that because they had to get some type of bailout from the Federal Reserve.
The Chinese are the biggest debtors, as we both know, and the biggest creators of credit is China. The biggest debt bubble in the world right now is China. It's not Japan. As bad as the rest of the development, it's China. And I'm not trying to pick on China. I believe their monetary system borders on being out of control. They have so much debt that they don't even know about. But as you've pointed out, they own the central. Most of the banks are controlled by the government or government banks. So they have enough FX reserves that they can get through a pretty serious crisis, which is coming. But remember, they just got themselves in as an SDR, as part of the SDR. They're trying to establish the yuan as a true alternative currency, but they're not in a real hurry to do that. They're setting up all of the pins, but they're buying gold like there's no tomorrow. I personally believe they have more than the United States government, but they don't want to push that too hard, not in terms of buying gold. They don't want the price going up. It's like Russia. They want to get Brazil and India. They want to buy as much gold as they can at this point in time, because in 3 or 4 or 5 years, when the super debt cycle finally implodes, and it's only a matter of time. The Kondratiev cycle is not about to reverse, so it's going to happen. We can speculate when that happens. Then there will be a massive readjustment, and he who has the gold as a currency will because it is a currency, will be the one in the power. That's why the Bank of International Settlement denominates its books in gold. They denominate it in gold, not dollars, gold. That tells you that it's a currency. However, I also think you're very right, Jason. I think that there will be a set of swaps between the U.S. and China because it's in everybody's interest to keep this thing alive, because the chaos that could come out of another financial crisis is unimaginable. It cannot be allowed to happen, and they will do every human thing possible to keep it from happening. So one of the best times to invest, Jason, is when you know somebody's trapped into a strategy and they are going to be forced to do certain things. It takes out your risk. And right now, the central banks are trapped. We can speculate on exactly how it'll unfold, but you know one thing, they'll print the money. And the moment you know that they'll print the money, it tells you something about asset prices. It doesn't mean there's going to be some scary moments that will force them into actions. Absolutely. But you need to know why there's scary moments and what's at the root of it.
Now, about this dollar crisis, you said you believe there is a dollar crisis. I don't think there's a dollar shortage. I think it's, an excuse that people made for borrowing too much money. So they knew that they couldn't pay back the money, They borrowed in U.S. dollars. If they're a foreign large foreign corporation or a foreign government, they were saying if they're a politician, I'll borrow the money now. I'll put the money in play, so make investments so I can get votes and win this election. And I don't care what happens a decade from now. I don't care if we can pay it back. You're seeing kind of the consequences of that in corrupt countries like Brazil that have borrowed more than 4 times their annual tax revenues, and they can't pay it back. So there's huge corruption scandals in Brazil. I've heard over $20 billion was stolen from Petrobras by corrupt politicians and rich oligarchs in Brazil. So I think, it's more of a responsibility problem that they've labeled it a dollar shortage, but they really knew ahead of time that they borrowed in dollar-denominated terms, and they knew they couldn't pay it back, and now there's a dollar shortage. That's my opinion of the dollar shortage.
I don't want to be confused with a conspiracy buff, so I won't speculate on that, but you need to ask, why did they borrow the money in the first place? Okay. and what did they use it for? But the point is right now that they can't, even if they chose to, they can't pay it. They just, their economy, their own currencies and their economy is not creating enough wealth for them really to keep up with the dollar or be able to borrow. And everybody has to borrow in US dollars, and they have to post collateral to be able to borrow, and their collateral is denominated in assets in their own country at those asset values in their currency. That's the problem. That's where the shortage comes. The shortage is coming from their inability to borrow more money in US dollars because of the collateral that they have to post. The central problem we have is a lack of unencumbered collateral, and that goes back to how we started. We're not creating enough new wealth. We're just consuming our wealth, and we're investing in more consumption. That doesn't work. You have to invest in things that will create new wealth. And by the way, you can only create wealth. You either got to mine it, you got to build it, or you got to grow it. That's the only way you find new wealth. And we're not doing any of those things at the rate at which it has to come into existence. It's pretty simple. Once you understand basic international finance, you can see the problems, and you can see the problem. It's been going on for a long time, Jason. When we got off the gold standard in '71 in the United States, we began a whole series of a lack of sound money, and then we moved into securitization and all the things of wealth. But in 1980, when we had the big debacle in bonds, and our interest rates were up at 19%, and Volcker came in and broke the inflation bubble. What people really don't understand is at that point in time, around the world, even though we were off the gold standard, at the end of the year, balance of payments had to be reconciled. So somehow at the end of the year, you had to reconcile gold or product or currency. What we did in 1980 there in that point is we decided on a global basis to go to credit. And so therefore on the balance sheets of the central banks, they would accept credit, if you would, from another country that owed them the money. And immediately we had leverage that came in. So that's why Japan exploded, because suddenly all it needed was a liability or a credit that says the United States owes me this amount of money. I put it in I can then leverage it up at 10 to 1. So the moment we went into that credit, it just started pyramiding. And so the more credit that you get, or you can create, the more credit that's created in another country, another trading partner. And then you get into securitization, which really exploded in the 70s. I'm not trying to give a history lesson here. I'm just trying to say why they're now trapped into this evolution. They can't stop it now. That's the problem. I'm not trying to be, that negative. It's an insurmountable problem that was created when we moved off sound money and we changed the method of international balance of payments. Settlement.
Yeah, there's a bunch of math problems now, because you have a pension fund crisis, which by 2050 is estimated it could be over $300 trillion in pension fund crisis. You have unfunded liabilities in the United States. You have pension funds in the United States, many of them that are drastically underfunded. I'm sure it's similar in many other countries. So these are all math problems that the obligations are not going to be able to be paid off. Now, Gordon, before we start recording,
you made a really good point. The World Economic Forum, that's the one that came out with that $400 trillion in pensions that are unfunded in the next 30 years. That is unpayable. It's inextinguishable. That alone tells you, just that one bubble alone, and there's no way out politically. And in the United States, to put it into perspective too, and people just seem to not get this, or it goes just, they don't want to get it. We talk about a $20 trillion debt in the United States. It's not 20 trillion. If you get in liabilities that we have in terms of unfunded pensions, unfunded Social Security, Medicare, et cetera, the fact is it's $84 trillion. And we have 10,000 baby boomers retiring per day, and it's coming due. So you can decide on it, but that's not where I'm going yet, Jason. It's not 84 trillion. If you think 20 trillion is a problem, and you think 84 trillion is it just can't possibly happen, that's not the problem. The problem is that we have a fiscal gap of $210 trillion. And that's the problem. And you say, well, what's the fiscal gap? Well, the fiscal gap is something that contains contingent liabilities. And what a contingent liability is, the United States government says, we're going to bail out Puerto Rico, and they need X amount of dollars. We don't physically give them the money. The banks give them the money, but we guarantee if they ever default, we will, on a contingent base, assume the liabilities. We have $210 trillion of contingent liabilities where we've guaranteed every banana republic and every harebrained idea you can imagine around the world that are all on our balance sheet. If we have any kind of slowdown in the economy, let's just assume 5% of that contingent liability comes due. That's $10, $11 trillion. That's half of the national debt right now, and we can't pay the interest on that.
That's almost the total U.S. GDP. U.S. total GDP is what, 17 trillion?
You got it. Exactly. So I'm trying to make sure everybody can understand why they're trapped. These are smart people, they're good people, but they can't turn around and say, well, we're not going to give Social Security, we're not going to give Medicare, and it's hell knows in Europe they couldn't even begin to suggest that. So the pension problem is so massive, it itself just is one item in that 84 trillion, and then the contingent liabilities of all these other countries that we've guaranteed, they've got pension problems that are part of their ability to fund the money. And by the way, when we guarantee it, let's pick on Puerto Rico, and they can't make 6% on their bond or 5%. The banks lend them the money, but they lend them the money at 14%. And you say, what? They can't make 6 or 7%? We're going to lend them at 14%? Well, it's called, hey, why not? Because they go broke. We're going to get the whole enchilada anyway. So what's happening is the banks are absolutely stripping and raping these people that we have contingent liabilities on, and that gets no press.
Gordon, is this why a lot of very smart people that I know, hedge fund managers, a lot of very savvy people with good track records for investing and managing money, either on Wall Street or in different financial markets, is this why a lot of them now are selling a lot of their assets, they're going to cash, and they're heavily net short a lot of stocks?
Exactly right. They understand this in spades. And you are right. They are going to cash in a big rate. They've been going to hard assets for a long time, but they're having troubles with those hard assets or what they're worth. They're actually liquidating, in many cases, their hedge funds. It's not just a hedge fund where people don't want to pay them their rates. They can't get the returns, but it's more than that. They see this problem. They don't know when it's going to happen, Jason. It's not necessarily going to happen next month, this year. They just know at some point that has to be reset. The world's not going to come to an end when this happens, Jason. What'll happen is we will have to reset and new institutions. It's simply the way the analogy would be, it was like Bretton Woods at the end of the Second World War. And we created the World Bank, we created the IMF, it all came out of that. We made the US dollar the reserve currency. We sat down, and over a couple weeks, we restructured what had to be done. When the crisis hits, a similar thing will probably happen. The world will be somewhat frozen. We will be in a state of wonderment, but we're looking for our leaders who will be forced to sit at a table and come up with a new structure. That's when the debt for asset swaps will happen. But But what'll happen out of it, in my opinion, the U.S. dollar will probably be devalued in the neighborhood of 80 or 90%. You know how much wealth destruction will be done for a lot of people who are sitting in U.S. dollars, for example. But so the world won't come to an end, and it'll be reset, and we'll move on. The key is who's going to be alive and well financially on the other side of that reset. And so they're leaving right now, and they're saying, I don't know when it's coming, but I'm resetting. I'm getting ready. And right now they're going to cash. The point is, they're not leaving that cash in the banks. They don't trust the banks to hold their cash. So where they're holding their cash and what are they holding it in? And that's why they're worth a lot of money, because they know how to do that.
Well, a lot of money, Gordon, whether it's China or the U.S., a lot of money lately has been going into Bitcoin. So if banks are not going to pay you any interest and they're going to take risk with your capital, and there's the possibility of bail-ins, you may as well put some money into Bitcoin or some of these other altcoins and speculate with it. I know, unfortunately, Gordon.
That's absolutely right. By the way, Bitcoin is now the new gold standard. That's why it's $2,400. And it's also money fleeing China that's really driving that big time. But for those, there's a new game of trying to find wealth protection, a store of your wealth. Sorry, I interrupted you there.
The sentiment for gold and silver is also probably worse than it was in 2014 and 15, even when gold and silver prices were actually lower than they are now. But I didn't get messages from people who were in the gold and silver community back then, a couple of years ago, Gordon, telling me they had sold all their gold, silver, and miners. And I'm hearing from a lot of people that they're doing that now, and they've given up on gold and silver. They know it's manipulated. They know it's undervalued and cheap. They don't know when the price is going to go up, and now they're chasing Bitcoin and Ethereum and all these other. Yep. I like Bitcoin a lot. But some of the other altcoins, I don't trust the supply on them. So we could have, infinite inflation on some of these other altcoins. But they're turning into, a speculative bubble because people see they're going up, and, gold and silver aren't going up because we were discussing this before, they're manipulated. But I think there's going to be, you were talking to me about this before we recorded, you've had success shorting. So the real economy in the United States.
We are actually, this has been a hell of a year for us. Over at Mad SII, but we are in our business right now has been more focused on value destruction, and we're looking at in the Americas decline specifically where value is being destroyed, and we target, and we've got about 7 industries that we've segmented into that we believe the rate of which value is being destroyed, and that means you have to be short, is absolutely significant, and where it's about to change. And I'll give you some examples. We went heavily into, we believe the problem in the United States retail industry is a massive problem of overstoring, the shift to the internet. We all know that. And we knew that the department store model is broken down. We knew that would lead to the malls breaking down, which they are. And now finally people are catching on that at least 310 to 400 of the 1,400 malls in America will be shut down within the next 36 months. But that's not where the money is being made. Yeah, you can make money on Macy's and Sears and J.C. Penney's, et cetera, which we have, by the way. But then the question is all the people in the malls who complete mall models are built on mall traffic, and we get into Abercrombie and Finch, we get into Urban Outfitters. I don't want to pick on. We have a whole list of them who all their stores are built on that distribution model, which is absolutely being killed because they can't go online. And millennials, how they buy brands. So I'll just stop there. But you take an industry like that, and you can see how it's being redone. And it's not where it's being redone to. It's being where the value is being destroyed. And there's numbers of opportunities right now, which are low risk. And if, in fact, we do have a crisis, Jason, I would rather be short during the crisis, wouldn't you?
Yeah, the problem with a lot of retail investors is they don't know how to short, and they try to do it on their own, and they either buy a couple shares of stock short, or they buy puts and don't understand what they're doing.
Oh, I'm not trying to recommend to our listeners to short. It's a very, very dangerous game. It's something the professionals should look at, or you've got to really know it, and you need a financial consultant. I'm just trying to give you an example of what we're looking at. But like you get into commercial real estate and retail, you look at the REITs that have heavy retail, and your financial consultant can look at it. We have a list of about 23 REITs right now, and they're down an average of 35% on retail. So just so, and what I'm trying to say is, with REIT, you're getting a basket of holdings, so you can diversify. But there's different ways of holding now.
Besides Amazon and e-commerce taking away a lot of regular bricks and mortar business, Gordon, I think also the consumer, the middle class consumer, they're tapped out. They don't have as much discretionary income because either their bills are going up, one, due to currency devaluation and higher minimum wage laws if you're a small business owner and you can't afford those cost increases, higher taxes, but then also they can't find reliable full-time jobs. I mean, the jobs numbers, a lot of the jobs being created are very poor quality jobs. I think this also translates. I'm not sure if you're short these things, but the casual dining, sit down type of restaurant. So the chain restaurants that are publicly traded, these guys for years have been loading their balance sheets with debt to expand. And I don't know if you've seen TV commercials for some of these restaurants, Gordon, but just to get anyone in the door now, they're offering buy one, get one free. They're doing 2 meals for $20. They're totally destroying their margins. They're barely trying to break even during the week, Monday through Thursday, just to get anyone in the door now. Some of the restaurants are doing buy one, get one free and entrees just to get people in there. These things are going to collapse too, I think, in the near future.
They are collapsing. They're in free fall right now. The restaurant, the more formal dining, depends on which end. You got to really segment these markets very clear. The restaurant industry is in deep trouble. Part of it is the wage problem, the minimum wage. It's a lot of these fast food guys are trying to go to kiosks and automation, and they're going to be somewhat successful. But you got to remember what's on their books with the real estate that they've paid and the real estate value and what they're paying for their real estates. And that's why you see McDonald's wanting to spin off the very few stores that they do own into REITs and moving them out. That's what I think. But retail, restaurants, and it gets into commercial real estate. The commercial real estate has never been a problem. It's been the biggest money maker in America for decades right now. It's almost like housing. Nobody lost money on housing until 2008. Well, nobody's lost money on commercial real estate. Oh, we have some slowdowns. All the pension plans and all of the insurance companies, really, that's where they invest. And the small banks in America, they invest in commercial real estate. Well, what happens when your retail starts to slow down, and as you point out, the consumer is tapped out, and you have excess floor space. I'm not talking about malls and big boxes. I'm talking typically on a commercial real estate, the ground floor is all retail. Above it, you have offices or you have apartments. But the big money is made on the retail space. When the retail space is not occupied, or you can't get the same dollars per square foot, the asset value of the building itself comes down. And remember that these buildings are all highly leveraged by the developers and investors who themselves are, however they're floating the debt structure that they have. And these debt structures roll over every 5 years because the banks want to make sure that the collateral is there based on the building value. So they don't have 30-year mortgages. They have 5, 7, maybe 10-year mortgages. Those rollovers, when we have a slowing consumer, are going to hit the commercial real estate market. I'm not saying it's going to collapse, but a $13 trillion commercial real estate only needs a 3, 4, 5, 7% kind of correction and a slowdown when it's leveraged to have profound impacts, right, Jason?
Yes, and the other thing that fueled this commercial real estate bubble was Dodd-Frank. I'm not sure if it was a intended consequence or unintended, but they tried to put the regulations on the banks from doing a lot of trading, leverage trades in different markets, and so they made it a lot easier for the large banks after the 2008 financial crisis to put money into commercial real estate loans instead of doing sophisticated trading for the large banks in the United States.
The way everybody's been chasing yield is buying commercial real estate. That's been the solution in the pensions, insurance, and the big money certainly since the financial crisis. I don't think that's going to be sustained. Not calling for a tremendous correction or problem. I'm just saying a slowing in itself has profound implications. But then you can see it in the REITs. I mean, I'm not speculating. Look at the REITs. Like I'm looking at one of our charts here right now. They're all down 35% year over year. That's a lot of money.
Yeah, I agree. I agree, Gordon. I've been interviewing hedge fund managers, and they've been short REITs for a while now. But yeah, there's a lot of things that
But
are
not
unsustainable.
all REITs. Certain REITs are still going to do well, but you gotta be very, very selective. You got to be careful with them.
I have one more question before I let you go. It has to do with President Trump. Do you think Trump's going to end up causing, a trade war in the near future with some larger trading partners? Is he going to make the mistakes of, Herbert Hoover and Congress did in the late 1920s with Smoot-Hawley? Do you see that coming in the future?
No, I don't. I think trade. I think Trump is a very good negotiator in terms of threatening, and then coming off his threats, like not too dissimilar as calling China a currency manipulator, then backing off it when they were willing to go toe to toe, or at least to try to go toe to toe with North Korea. He's a traitor, and he is not going to create. He's not going to create trade wars. He'll threaten it, I think, but we could see probably and tariffs. And he'll threaten them, but I just don't see those happening. That's not what I'm worried about. I'm more worried about Congress's inability to put anything through into legislation. We are in total and absolute gridlock, and have been for a long period of time. And that is more troubling, because we have things that need to be changed right now. And whether it's, one of the things I was a supporter of was Trump's infrastructure strategy, and a well-targeted infrastructure strategy being funded through private partnership placements and tax incentives, versus, and the Democrats wanted infrastructure spending too, and also both wanted $1 trillion. And it's neither one of them it's not even on the table yet. Discussion only, and we need that money to be applied soon to be able to at least to push off the a recession. I'm not a supporter of stimulus spending. Please, nobody translate that for me, because the bang you get for it. But at least we could be spending some money correctly. It's more reflective that we can't get anything through Congress. So I don't see trade wars happening. Maybe I'm wrong, but I don't see it happening. I don't think that's the problem. I'm more concerned there's no trade, period. Forget trade war. There's no trade. Global trade is collapsing.
Yeah, I mean, Trump's ultimately a deal maker, so he's going to be probably willing to do some type of compromise. I'm not in favor of any central planning,
he will. That's
really.
Well said. No matter what, he will adjust. He's not dogmatic. He's not cut with some philosophy. If this is not working, he'll try something else. We just saw it with the climate agreement. I'm not, walking away from it. He wasn't, in my opinion, and I don't want to defend the man in any way, he wasn't walking away from the science of climate control. He was saying this deal sucks for America. Now, we should do this, and I know 194 countries signed it, but look at the deal. It's absolutely rape and plunder of America. So let's renegotiate a deal that's fairer for America. I'm not trying to comment on that so much as Trump is very pragmatic. He's a businessman. And so he looks at what's right for America, for the people that are going to put him back in power, creating jobs, et cetera. So he'll shift. There's no way he's going to hurt trade. That's why he backed off on NAFTA. He said he was going to cancel NAFTA. He said to both Trudeau and the president of Mexico, I'll renegotiate it. Okay? By the way, stopping NAFTA would be a monumental problem. I don't think Americans truly understand the significance of NAFTA trade.
Yeah, I don't understand the whole trade agreement with NAFTA. I know there was a lot of jobs lost initially in the United States. Lou Rockwell, who I've spoken to in the past, he said when he was working for Congressman Ron Paul as his chief of staff, he went to the printing building in Washington, D.C. to read the NAFTA bill, and he says it was, over 1,000 pages with all these special, agreements for individual corporations. So there's a lot of, stuff stuck into these bills that is corporate fluff there with the lobbying. But yeah,
it started as a 26-page document as what they agreed on. And then as they started putting more and more amendments that the lobbyists came in, it ballooned to absolutely. But what we never had the visibility to those changes. We only had the visibility, we the taxpayer and the public, to the original agreement. And at the time, I was living in Canada, and I said, this is a fair agreement. I thought it was a good agreement. I thought it was really good for Canada. I thought sign this thing in a heck of a hurry. But since then, it's a totally bad deal for America. It needs to be renegotiated. But it doesn't mean you have a trade war over it. It needs to be fair. And look at Canada now reacting on the lumber industry and now putting in $600 billion of funding. 600 million, I stand correct. $600 million to fund the softwood lumber in retaliation. So I don't like what I see, but they'll renegotiate it.
Yeah, it'll be very interesting to see if we do get trade wars, because trade wars then could accelerate collapse in a lot of these different real world economies very, very quickly.
Not going to happen. Jason, it's not going to happen. But I'll tell you this: Trump will be blamed for the slowdown of the global trade.
Oh, of course. All the people here, even a lot of Republicans hate Trump and are sabotaging him. They're leaking behind his back. They're blaming things on Trump. They're blocking a lot of his domestic agenda, whether it's an improved healthcare bill or the corporate tax cuts. There's Republicans blocking a lot of this stuff too.
Exactly.
So it's not just Democrats. It's Republicans who also are jealous of Trump. The popular movement that he had, and they hate him. So
Trump's biggest mistake is he failed to deliver on one of his promises, and that was when he went to Washington to drain the swamp. And right now, the swamp is draining him.
Oh, he was never going to be able to drain the swamp.
I agree. I agree.
He admitted this when he got here, that he didn't understand how bad things were. I mean, Gordon, he can't go, in a private sector business, if Trump wanted to turn around one of his companies, he could fire thousands of people, he could reallocate capital, and within a few years, he would start turning around the business. You cannot do that with the federal government here in the D.C. area. Ronald Reagan was really the last president to actually try this. He defunded a lot of government agencies down to almost zero, and the bureaucrats who weren't fired, they just waited him out. They waited out 8 years, and then it was right back to business as normal. Their budgets went back to normal levels when Reagan left, and the federal government here in the DC metro area is a lot bigger than when Reagan was in power. So Trump inherited a huge mess, and he's not going to be able to go out and fire all those. The government budget, Gordon, the federal government budget, 80% of it is locked in for 5 years from now. So he cannot go and cut 80% of the budget. It's just not possible with all the way the rules are done.
Yeah, Trump's mistake, one of his many mistakes, is he's trying to run the government like he's a CEO. And you say, well, we need a CEO running it. Well, the government doesn't work that way. And I'm saying that somewhat facetiously, and that is the truth of the matter is the good old days were what you described, where they tried to make some changes and they suddenly went back to and reset to the way they were. Today, what the real strategy is to do nothing. And I heard one of Obama's strategists actually articulate this one night, and I thought, I can't believe it, but he's telling the truth. That is, your job is to do nothing, because if you do anything, you're going to get torn apart in the press, in the media, by some group for some reason. So don't do anything. What you do is you wait until, I won't use the word crisis, but you have to wait until there's an event that's brought on and it requires action. Then you step in and you take decisive action. But what will happen is with your action, you will not get the incredible criticism you would have got if by just doing new creative initiatives, because people are desperate for the problem to be fixed. And they say, I don't know if I agree with it, but we got to do something. And they kind of accept it. So successful. And Obama really, other than Obamacare, really never did anything. But he was very, very good at doing nothing but playing 465 rounds of golf, but then coming in, and not trying to be critical, just being factual, but then coming in when something has to be done. And then you can question whether it was the right thing. But it was good politics. He made himself very, very popular. Trump is trying to be a CEO and make all sorts of changes, whether you agree with him or not. But he believes they're in the right interest of America, and he's getting fried no matter what he does. He's getting fried for him. That's not the way to run this government. And that's the wrong, and that tells you something about my feelings about a government. The problem is, as Ronald Reagan said, the problem is the government. The government,
yeah,
the government is in the way, and we got it right now, Jason. With good, when a government gets out of the way, and there is a role, then what happens is the capitalist system works, and what you end up getting is you're getting more for less. What happens when the government gets in with regulations and social programs and everything else, you end up getting less for more. And I ask you to go around, whether you're looking at food, services, anything you get today, you're paying a lot more and getting less and less in terms of quality and service. And
I 100% agree.
And that's what's going on. And then you get to the point, and we've been there a long time, where you end up consuming more than you produce. And then that gets to be a way, because when you consume more than you produce and you take on more debt, you end up being a 70% consumption economy. What I'm defining here is the trap. This is the trap that I feel sorry for the politicians. I have no idea why somebody would want this job. They can't do anything. The bills are handed to them by the think tanks. They're lucky if they can ever read them, never mind make any changes, but they're somehow responsible. And so they can't make the changes. And Trump will demonstrate that even as a president, he can't make the changes, whether you agree or not, that need to be done. That's our problem. And the only thing they ever agree on is spending more money. They will throw money at every problem. They always do, until there's no money left. And I don't mean to be negative. I'm being factual as an investor. And once you get your mind around that and you can accept it, and it's a very tough thing to accept, then investing actually becomes quite easy. That's why we're totally focused on value destruction right now.
And that's how empires collapse, whether it's the Roman Empire or the British Empire, so many others. And that's why we're going to eventually, in the near future, probably have a global financial system reset.
A reset, but not a crisis, a reset.
Yeah. So, I actually think Obama was a criminal, and I think, he hired criminals in the Department of Justice, knowingly hired criminals, whether it was Eric Holder, Loretta Lynch, or James Comey, and he let, white-collar criminals, billionaires from both political parties and running, Wall Street banks and others, he let them get away with, huge crimes, and knew they wouldn't be prosecuted. And then there was tons of billions of dollars in money and corporate fines that were funneled to select, George Soros programs as well. There was a lot of crimes committed under the Obama administration. So maybe he didn't totally destroy things, but he destroyed the rule of law. It accelerated under Obama that, the rule of law in this country went down, even for the confidence that a regular citizen, a middle-class person, no matter what color you are, or age demographic, the confidence you have in, the rule of law in this country, it went down a lot in the 8 years of Obama. Hopefully Trump can restore that, but I think there's going to be a global financial crisis, Gordon, in the next 2 or 3 years. It's almost guaranteed. I can't tell you where it'll start, because we've been speaking for an hour now, over an hour, so I want to wrap this up. But hopefully our listeners understand that we've outlined so many different problems all over the globe, and it's not a really good time right now to be long a lot of different types of stocks, because people keep asking me for new investment ideas. Well, maybe with cheap capital, certain technology like robotics or automation with higher minimum wage laws will be good investments, and that'll be deflationary too with robotics and automation, but there's not a lot of other good investment ideas to be long right now, especially with valuations. So, Gordon, in wrapping this up, please tell our listeners more about your work.
Yeah, the best way to follow the work we're doing in identifying value destruction is a new website we've started called MATASII, MATASII.com. And we create what we call strategic investment initiatives and outline where we don't give investment advice. We just say these are areas you need to really do your own research and do your own due diligence. And these are backed up from the macro analysis, from fundamental analysis, and probably one of the finest technical analysts in the world on technical charts to support some of our thinking. So I recommend everybody come and have a look at matasii.com.
Great. Well, I want to thank you again for your time today, Gordon, and hopefully we can have you back on again in the near future.
Enjoyed it. Sorry we were so long here, but we covered so much today, Jason, and I hope it wasn't too troubling to our listeners. I certainly enjoyed it. I don't get a chance to be as broad-ranging as you were with us, so thank you very much for the time.
Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALLSTFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street for Main Street.